And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to Fed Day. That's right. It's all about Federal Reserve today because that's the big news that's moving markets and the news channels this morning as well. Everybody's talking about the Fed. Yesterday, had their meeting, came out pretty much as expected, no rate hikes, and it's beginning their taper this month of $15 billion a month for quantitative easing. Now, remember, following the pandemic shutdown, the Federal Reserve started buying $120 billion a month. Now, we've been doing this since March of 2020, so here we are. More than a year later, March 2021, here we are in November, and we've been buying $120 billion a month over the course of that time frame. So, close to $2 trillion here pumped into the economy. Expansion of the balance sheet, of course, that liquidity has been flowing, into the financial markets. And again, there's a big debate between individuals as to whether the Federal Reserve bond purchases actually go directly into stocks. And there's a big debate on Wall Street. It's like, no, the Fed doesn't actually facilitate buying stocks. It's just, they're putting money into bank reserves and the banks are lending that money out. Well, may be the case, but if you take a look at bank loans, those have been drying up very sharply here over the last couple of years because, again, why should banks take a lot of risk lending out money to individuals that may not pay it back versus using that liquidity for their prop desk where they can buy and sell equities and support financial markets? And again, if you take a look at, as a good example, take a look at Goldman Sachs, Bank of America, JP Morgan, that have major prop trading desks. Take a look at their earnings on a quarter-over-quarter basis. Where do their earnings come from? And if you take a look at just the latest earnings, their earnings are coming from two places. One, moving loan loss reserves back onto their balance sheet. So when, during the March 2020 crisis, the banks moved a lot of cash into loan loss reserves in expectation of there being a lot of defaults. Well, that didn't occur because of $1,400 checks to households and rent support and moratoriums on rent and everything else. So it wasn't a lot of defaults that occurred. So now all that money that's sitting over those loan loss reserves and bringing that back onto the balance sheet, well, that acts as income for earnings per share and improves their balance sheet. But they didn't really make any more money, right? The money was just sitting on the sidelines. The other side of where their money's coming from is where? Their trading revenues. That's right. Most of the income from these banks come from their trading revenues. So the question is this: if the money from the Federal Reserve does not wind up in the markets through the bank's prop desk, then how is it that the trading reserves of these banks are so strong, right? But again, this is the big argument. But whether or not you think that money actually goes from the Federal Reserve directly into the financial markets through the banks, or if it's just a psychological support that when investors think the Fed is doing this, they know that when the Fed is doing QE, markets rise. So they just psychologically, kind of like Pavlov's dogs, right? They ring the bell, they go out and buy stocks. So whether or not it's a physical, actual function of cash flowing into the financial markets, or whether it's just a psychological support for market, really is irrelevant because it's the effect of QE on markets lifting asset prices. And in fact, there's a very high correlation between the size of the Fed's balance sheet and the rise in the market. So again, if we look back at the financial markets over the course of the last decade, strip out stock buybacks, which have made up about 40% of the increase in the markets, and strip back the Fed's QE, the markets are going to be basically are not much higher than they were at the peak of the market in 2008. That's how much support has been driven into the markets financially from these two areas. So again, as we talk about this, and Michael Leibowitz will be joining me this morning, the Fed made two important comments that we want to talk about today in particular. One, they talked about, well, inflation may still be transient. They still are leaning towards this idea that these inflationary pressures in the economy, a function of the supply chain disruption, is simply a function or a side effect of the COVID problem, right? The COVID pandemic. So, and as soon as we get the pandemic under control at some point in the future, then these supply chain issues will resolve. But is that really the case? The other side is they're not really worried about the economy because employment is still not back to full employment levels. We still have more room to go. So again, no reason to hike interest rates here, despite the fact that we're running over almost 5.5% inflation right now in the economy. And of course, individuals are certainly feeling that pressure through higher gas prices, higher food prices, those type of things. So again, now this was a fairly dovish statement by the Fed yesterday. And again, the market was already pretty much primed and prepped that the Fed was going to announce a reduction of their quantitative easing, their bond buying of $15 billion a month. That's been well telegraphed here, so no surprise. The one thing that did surprise, I think, the markets a little bit yesterday was the fact of this attitude towards, well, we're really not back to full employment yet. And the problem for this, and something that Mike and I will talk about today, is that the definition of full employment, what is actually full employment in the U.S. economy, may be changing. And this could very well put the Fed behind the curve. But again, that kind of dovish sentiment that came out from the Fed yesterday in terms of their announcement did lift stocks. And we are now over 2 standard deviations above the 50-day moving average. This is historically a very overbought position for markets. If you take a look at our overbought indicators, they are back to very overbought levels as well. And our money flow indicator, very elevated. So again, when we talk about the markets and risk management and the things to do with your portfolio, right now there's a lot of exuberance in the markets. And since we had that correction back in September, October, that 5%, we've now completely recovered that correction. We're back to all-time highs, back to very extended levels. And now, this doesn't mean the market's about to have a major correction or a major crash, but from the standpoint of just managing some risk in your portfolio. If you didn't like that 5% correction back in September and October, we're going to have more of those. And so if you didn't like that correction, well, there's too much risk in your portfolio. Think about reducing some of the exposure you have to the markets and lower that volatility. And things, if you've got some stocks, and Mike and I have been working on this all week in our own portfolios, we've got some stocks that have done exceptionally well. Ford, NVIDIA, Albemarle. These stocks have had terrific runs. They are very elevated. And we just went in and reduced those positions a little bit, just took some profits off. Now, we still own the positions, a big chunk of those positions we still own. We just took a little bit of money off the table because eventually those positions will correct, and then we'll buy some more of those shares back at better prices. So again, just because you own a position doesn't mean that you can't reduce it. One of the mistakes that a lot of investors make is they think that you have to sell everything. And then once you sell it, you can't ever buy it back. There's no rule. There's no law in Wall Street that says once you sell something, you can't buy it back. And there's no rule that says you can't harvest some of the crops. We talk a lot about managing a portfolio like a garden. And, if you plant a garden and it grows and bears fruit or vegetables and you don't harvest those fruits and vegetables, they'll rot on the vine. And if you don't weed the garden, sell your losers and laggards, the things that aren't working, the bad decisions you made, if you don't clean those out of the garden, eventually the weeds will take over the garden. And this is just a very simple analogy of how to manage your portfolio. And if you're not doing that, you really kind of set yourself up for larger losses at some point. I know the idea of larger losses really don't seem like a possibility at this point, right? Because we just don't have corrections anymore in the markets, but eventually we will. And if you haven't properly prepared your garden, you're going to suffer much larger losses. And this is why we talk a lot about risk management, portfolio management rules. If you go to our website, realinvestmentadvice.com, we have plenty of things under the search for rules. Be right back after the break with Mike Leibowitz.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
We're putting 2021 behind us and getting ready for 2022. Be prepared with Lance Roberts' year-end economic outlook in our next Candid Coffee, Saturday, November 13th. From taxes to interest rates and markets, we'll share insights from Richard Rosso, Danny Ratliff, and special guest barista Lance Roberts. Saturday, November 13th. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff, Rosso, and Roberts. RealInvestmentAdvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Hi, welcome back to the show this morning. I'm your host, Lance Roberts. Of course, it's been kind of an interesting 24 hours with the Federal Reserve. Michael Leibowitz joining me this morning to dig a little bit into the statement from Jerome Powell and, again, kind of where potentially what markets are thinking is going to happen versus what may actually happen. May be two very different things. Michael Leibowitz, welcome to the show this morning. How are you?
Great, thank you. I was listening. You were very riled up in that first segment, so I'm not sure what I can add.
Well, it's going to be interesting. There's a lot really to kind of unpack here. Let's jump into the unemployment part first of all, and then because in the next segment we'll get into the inflation side of this. I thought it was very interesting. The Federal Reserve is now talking about the fact that we're not back to full employment yet, and when in 2020, right before the pandemic shutdown, we had just marked a record low unemployment here in the U.S. of a little bit over 3%. Something really more of an anomaly than anything else. And now the Federal Reserve is now kind of anchored to that very low level of unemployment in the U.S. economy and saying, okay, that's where full employment is. We need to get back to there first before we do anything else. And that could really be a bit of a risky maneuver here because, again, full employment may not be the same now post-pandemic. We saw a lot of people leave the workforce that may not ever come back again. People's dynamics of work has changed as well. A lot of people are working multiple part-time jobs that don't count as, being employed under the way the BLS calculates employment. So kind of what are your thoughts here? Do you think the Fed is maybe setting their mark too high for what they consider full employment?
Yeah, well, the question I think is ulterior motives, right? What are they doing? So we know that inflation is running over 5%. Their goal is 2%, and one of their two mandates by Congress is stable prices. Mm-hmm. Prices aren't stable by any measure. Every measure, even their own PCE, is well above what it should be, and the Fed admits it, right? So the other thing they have on their side is employment. So, we could debate all day if employment is back to where it was. And if I was a lawyer, I feel like I could present both sides of that case and win both sides of that case. Right. Powell statistically is correct. The unemployment rate is 4.8%, and it was in the low threes. Right. The participation rate is much lower than it was before. Now, on the flip side is we have a record number of job quitters. These are people voluntarily leaving their jobs to look for new jobs, right? That's a sign of a healthy market. We have, almost 30-50% more job openings than people that are unemployed. We have more retirees. Mm-hmm. A lot of people took that opportunity during COVID to retire. So, like you said, Lance, there's not an apples and apples comparison to the way things were in 2019. And by the way, from 2015 to 2019, the average unemployment rate was 4.4. We're at 4.8. So again, you can kind of make a case both ways, and I think they're strong cases. But the market is for jobs, for employment, is very healthy. It may not be tip-top health, but it's very healthy. And the fact that the Fed is so dovish that they basically got dragged to the altar to taper and refuse to even talk about raising rates tells you there's more to the story than employment, right? They should be raising rates by now, right? They should have quit cold turkey on QE like the Bank of Canada did,
right?
Like other smaller central banks are doing. They're not. So why is that? And there's two good reasons in their minds why not to do that. The first is asset valuations are predicated on easy money policy, right? There's nothing fundamentally that justifies where the prices of most stocks, most bonds, most assets, houses are at this point, right? What justifies it, and you said it well in the first part, was either the money is somehow leaking into the market or it's just a confidence game. But either way, and you can argue, again, both sides, either way, the Fed's behind that. And then the other thing is the debt trap. The Fed has so much debt to issue, not just from this current fiscal year, but you're still paying back all the prior years. And you don't pay it back. You pay it back by issuing more debt.
Right.
And then throw in corporate debt and personal debt, and we have a debt problem, and we can't afford higher interest rates. So,
and I think that's really kind of a key point that is worth reiterating, because I think a lot of people really overlook that one issue more than anything else. We there's a lot of analysts, in the markets right now saying, oh, well, interest rates have to go up. The 10-year treasury rate it's got to go up. It's going to be 2.5% or 3% or 4%, pick your number. If inflation is 5%, then, the 10-year treasury rate should be 4%. What everybody kind of forgets in that analysis, and that's not an incorrect statement. Historically, there's a very high correlation between inflation and interest rates and economic growth and those type of things. The problem I think most people forget is that we have so much debt in the economy, and the economy is driven by debt. And again, to your point, Mike, it's not just the fact we're running $29 trillion worth of government debt. We've also got record levels of household debt. We've got record levels of mortgage debt, record levels of auto debt. Basically the entire sustainability of the U.S. economy is a function of debt increases over the course of the last really 30, 40 years. Consumption has far outpaced incomes, and that's been a function of people being able to access continuing, easier rates of credit. I can access credit easier, and the interest rate on that debt has been steadily falling. And so the problem now is if interest rates do go up, you have a major problem in the economy because it will stop the entire economic activity. People won't buy cars. They'll postpone refinancing their house. I mean, who's going to refinance their house at a higher rate? Who's going to buy a house at a higher rate? The psychological impact on consumption is dramatic. So the Fed's really in a bind here between hiking rates and the underlying economic growth environment. And really, while they may be focusing on the headline function of employment being not back yet to full employment, I think the bigger risk is that and they're aware of this, is that economic growth is slowing down rapidly, and hiking interest rates is a brake on economic activity.
Right, and it always has been. The problem is they are gunning the engines right now. And yes, they're going to taper QE by $15 billion, but even after that, they're still gunning the engines. Mm-hmm. They're taking off the minimum possible. Right. You can kind of think about this the other way. What if employment was all the traditional statistics of employment were back to where they were in 2019, right? Mm-hmm. But inflation, let's say CPI or PCE, we're running just a hair under 2%, right? The Fed's stated objective is 2%, but on occasion they've said they wanted to run a little hotter than 2% to make up for years past where it was not up to 2%. So what if we were there? What if we were kind of in an opposite situation where employment was back to exactly where it was in 2019, but inflation was running 1.8%? I guarantee you every word you would hear out of the Fed is, we need to get inflation up before we can stop tapering, before we can raise rates. So these are excuses, Lance. They have two quivers to use as excuses, inflation and employment. They certainly can use inflation, but employment, you can statistically say that Powell is correct. You can, again, also make a case that he is completely misjudging the market, doesn't understand the dynamics. And I'd say he does understand the dynamics. It's the excuse.
Right.
This is the excuse to keep policy,
very
we use some huge adjectives like extreme, right?
Right.
But I don't even think extreme covers what they're doing if people were really to realize what's going on here. Zero interest rates. They're still buying, even with their taper, 105 billion bonds a month.
Right.
That's a crazy pace of purchases that dwarfs what they were doing 10 years ago.
Well, and I think, and again, when you take a look at, and we kind of glossed over this one point, which I think is, the most important point about the economy, which is the labor force participation rate. That labor force participation rate has barely risen from the pandemic lows. And that's okay. So good. Labor force participation rates come up from the pandemic lows. But what people don't really understand is that labor force participation rate was in the 70s. It's now in the low 60s. That was in the mid to high 70s back in 2000. And it's been declining. It declined during the dot-com crash. It declined further during the financial crisis. It declined further after the pandemic shutdown. And every time we go through these economic crises type shutdowns, that labor force participation rate gets lower and lower and lower. And that equates to the fact that we have slower rates of economic growth. The rate of economic growth back in 2000 was almost 5%. Now we're hoping we can get 2%, and that's a good number. This is all part of the debt structure. It's all part of this monetary policy that continues to erode economic activity. But we don't want, nobody wants to really face up to that because we all love a rising stock market. That's great. Don't do anything to mess up the stock market is the first principle. And the second principle is don't raise interest rates so I can keep financing things at a cheap price. Right.
Those are the two Fed mandates.
Yeah, that's really what this comes down to. And really it has nothing to do with employment at all. So we'll get to that. Look, after the break, I do want to touch on a little bit about inflation because he did make some interesting comments. He's still hanging on to this hat of this idea that inflation is completely transitory and that, boy, just as soon as we get everybody vaccinated, and get this virus behind us, the supply chains will magically disappear. And, is that really the case? We'll come back with Michael Leibowitz right after the break, talk about inflation, causes, consequences. Don't go away. I'm your host, Lance Roberts. Be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
We're putting 2021 behind us and getting ready for 2022. Be prepared with Lance Roberts' year-end economic outlook in our next Candid Coffee, Saturday, November 13th. From taxes to interest rates and markets, we'll share insights from Richard Rosso, Danny Ratliff, and special guest barista Lance Roberts. Saturday, November 13th. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff, Rosso, and Roberts. Realinvestmentadvice.com.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN. RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
If there's a concern that taxes are going to go up on potentially those making over $400,000, that's what they tell you. Reality is it'll go up on everybody because taxes get passed down. And the whole idea of economic trickle down doesn't work, but the one thing that does trickle down is taxes.
Listen to the Real Investment Show podcast from your favorite service. Same show, your schedule at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows. Subscribe and bookmark our YouTube channel for The Real Investment Show. Or just click on the show links at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. I'm your host, Lance Roberts. Michael Leibowitz joining me. Headline on CNN right now. Larry Summers' inflation warning comes true. Now haunting the White House. Inflation is an issue, and this is a problem historically for presidents, regardless of, party affiliation, whether it's Democrat or Republican. Jimmy Carter, the most famous, of course, probably when it comes to, rising inflation and presidencies. What do you remember Jimmy Carter for? Inflation, right? That's his whole legacy. The entire legacy of the Jimmy Carter administration was inflation. And here we are, really very much in the same position now. Inflation is rising for consumers, right? Now, regardless of how you want to measure inflation, whether it's CPI or PCE or trimmed mean PCE or median CPI, I mean, there's 500 different ways to measure inflation in the U.S. economy. What it really comes down to ultimately is the consumer and their ability to maintain their standard of living. So here's really the measures of that. One, are wages rising fast enough to compensate for the rise in prices? And that answer right now is no.
That depends who you ask, Lance.
The second thing is that when you are trying to just make ends meet, and again, your choice is between your income and going into further in debt, that's a problem. So when consumers go to the gas pump and they fill up at the gas pump and it's no longer $30 to fill up, it's now $60 to fill up, whatever the number is. or they go to the grocery store and either they can't get what they want because it's simply not available, or prices have risen markedly. Go out to eat. The cost of breakfast has risen more than 30% in restaurants just over the course of the last several months. That's the inflation that consumers feel. So, Mike, now to you. This is a problem for consumers, particularly in the economy with inflation.
So let me backtrack a little bit. So the White House only a few days ago said that inflation isn't really a problem because wages are rising faster than inflation, right? We know the answer to that, but that's what they said. And that shows you how important inflation is. Look, Biden knows, and every Democratic congressperson and House rep knows that inflation is the key to their reelection hopes, right? So the natural response is, yeah, inflation is a little higher, but don't worry, you're making more money. So net, you're better off. Powell, point blank, yesterday said he's not worried about inflation because wages are still below the rate of inflation, right? Because that tells him we're not getting even into a spiral of inflation because there's still not enough inflation in wages. So there's, everyone has their side, and they use these political rallying calls to justify things that they're doing. Look, inflation is running more than wages. There are an incredible number of statistics that tell us that. Doesn't mean some people are making more, but on average, people are not. Right? People are losing. They may make 10% more, but they're paying 15% more. Right. And that's what's going on. And, you can look, Lance and I look at a million stats on inflation, and the graphs, they all go up to a different degree, but they're all going up. You just talk to people, right? I mean, regular people. People are telling me this all the time. They're asking me, why is inflation going up? They know that, this is what I do. We study this stuff. Right. And they're telling me, all these examples, and why is the price of gasoline over $4 a gallon? Why is this? Why is there still no stuff on the shelves? And look, the bottom line is their inflation. And I think what we saw on Tuesday night at the elections is part of that has to do with inflation, right? Inflation and taxes are the two presidential killers. Right. And we have inflation. There is no doubt about it. And the Fed is not addressing it, right? So, I think one thing that to think about is Biden has slowly been bringing up the inflation topic. At some point, he's going to be putting pressure on Powell to do something about it.
Yeah, but this was an interesting kind of point, though, with the Fed yesterday in terms of their stance on inflation, is that he's still kind of focused on this whole idea that, it's transient in nature, and that as soon as we can get everybody vaccinated and get the Delta variant of the virus under control and get everybody back to normalcy, that these supply chain disruptions will magically disappear. But that doesn't really explain, the virus alone doesn't explain a lot of what's happening with the supply chain disruptions. Truckers are simply, there was articles out yesterday. Truckers are realizing that it's not cost effective to go wait 12 hours in line at the port of LA to pick up one container and drive it somewhere. There's more to this story than just the pandemic virus, even though that's the headline-driven excuse. There seems to be more to the story that's driving the underlying inflation that may not be as transient as Powell expects.
Right, and it seems like your example, wages are a big one, right? And when wages go up, corporations, that comes out of corporations' bottom line. So what do? They raise prices, and that's called a wage price spiral. Right. And that's somewhat what Powell was alluding to, but that is going on. And look, this labor market is healthy. How healthy? We talked about that. We can debate that all day. But for the first time in a long time, workers have power, and they can ask for raises, and they are getting raises. Right. And that will generate some inflation. How much? Depends on what the economy does, depends how much power they ultimately have. But that inflation is a real concern. And, the other part of this debate is, Lance, what can the Fed really do? Right. Well, they can raise rates. right? That will squash inflation because it will limit economic growth because it limits the amount of debt that entities, the government, or people can take on. But a lot of this is out of their control too. But on the employment side too. So that's kind of the joke of this whole thing is that how much power do they really have? And what are they going to do about it? And what are their ulterior motives?
Well, I think this comes back to something that we've touched on before, which is the Fed really is trapped. And there's more to this story about hiking interest rates than just, inflation is transient, it's going to come down next year. And look, it may. If we do get into a slowdown economically, inflationary pressures will decline. If we do start to head back towards a recessionary spat in the economy, inflation will decline. That's just a function of economic growth and supply and demand. So, there are certainly reasons to suspect that inflation could well be transient going next year, but the economic consequences of that are not good. In other words, you can't squash inflation and keep economic growth high. Those two just don't work together. And I think the Fed's well aware of that. And the big problem for the Fed, to your point, is interest rates. If they begin hiking interest rates, there's a vast number of companies out there right now that are dependent upon extremely low interest rates to finance debt just to stay alive. We call these zombie companies. And those are running at a record level right now. So, we were talking about the consequences of hiking rates, that people won't refinance houses. They won't buy houses. Zillow is a good example, was in the house flipping business for about 30 minutes and figured out that wasn't a good idea. So can you imagine what happens to a Zillow if interest rates start to go up and mortgage rates start to go up? Can you imagine what happens to the economy when credit card payments, which are variable, start to go up and people have more money going of their disposable income going out to pay credit card debt? And of course, imagine what happens to the stock market if we start having mass bankruptcies because, these zombie companies can't refinance their debt at low rates. There's so many more problems underlying the market and the economic structure than just inflation. And the Fed, I think the Fed is well aware of this, and they're just looking for an excuse not to hike rates because they know what the consequences are.
Right. And Lance, here's the crazy part. Let's just talk about the mortgage market. Mortgage rates go to 4%. There are huge problems in the real estate market. Right. No one's going to be able to sell houses. There's a lot of people in the last year and a half, 2 years that bought overpriced houses, that are sitting on overpriced houses. And what happens if they lose their job? What happens if they lose a source of income? Right? They have these big payments. The price of the house starts declining. They have, negative equity. What do? They take their keys, they stick them in an envelope, and they mail them in. And that's what happened in 2007, 2008. Yep. And you're kind of setting yourself up for a similar thing once again. Yep. You're propping up asset prices, in this case houses, to levels that don't match the underlying fundamentals, the sustainable fundamentals.
Yeah, and what you brought up is, what is something that actually occurred back in the late 70s and early 80s, and it's called jingle mail for people that don't remember that. But back in the late 70s, early 80s, because of inflation and high interest rates, people couldn't afford their houses, and they were, what Mike said, is literally putting keys into envelopes and mailing them back to the bank saying, hey, there's the house, take it, because I can't afford it. And it was called jingle mail, and that's where that whole keys in the envelope sentiment came from. But again, we did see some of that, not directly to that degree in the 2008 financial crisis. That was where the banks were just kicking in doors of homeowners and taking houses that they didn't even have mortgages on. But that's a different story entirely. But when we come back from the break, let's switch over to the markets, because all this that happened yesterday, right, with the Fed drove markets to all-time highs. Speculation running rampant in markets. A massive short squeeze is driving markets higher right now. How does this all work out? How does it all end? We'll talk about that when we come back from the break. I'm your host, Lance Roberts. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
We're putting 2021 behind us and getting ready for 2022. Be prepared with Lance Roberts' year-end economic outlook in our next Candid Coffee, Saturday, November 13th. From taxes to interest rates and markets, we'll share insight from Richard Rosso, Danny Ratliff, and special guest barista Lance Roberts. Saturday, November 13th. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff, Rosso, and Roberts. Realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So, welcome back to the show. Michael Leibowitz joining me this morning. You're listening to the Real Investment Show. Realinvestmentadvice.com. Get by our website. Make sure and sign up. November the 13th, we'll be doing a end-of-the-year market overview and update kind of candid coffee. So, if you go by the website, you can register for that. It's an online Zoom event. Tune in, and we'll spend the morning with a cup of coffee talking about markets and money and where things are headed into the end of the year. But one of the things that, was interesting yesterday, of course, was there was this concern by investors about how the Fed would actually navigate, this, policy meeting. We all were well aware that they were going to taper their balance sheet by $15 billion. That was well telegraphed. The fact they weren't going to raise interest rates was well telegraphed. We all knew that. So what was it yesterday that was, so good about the announcement that was, and this was really what drove the markets. Was it going to be more hawkish leaning? In other words, we're going to talk about maybe hiking rates sooner than later or more dovish. And he threaded that needle on the dovish side very well, despite the fact they are tapering QE. Despite the fact that there is inflation in the economy, he threaded that needle very well with a very dovish statement on, the potential no rate hikes, kind of in the foreseeable future. Markets like that because, again, that doesn't disrupt the flow of liquidity in markets, at least at this point. So markets rallied to all-time highs yesterday. As we talked about in the opening segment of the show this morning, markets very overbought. We're more than 2 standard deviations above the 50-day moving average. I know, bunch of technical mumbo-jumbo. Just trust me. You're just stretching a rubber band as far as you can in one direction. That's all that means. And eventually, when you do that and stretch the rubber band, it has to relax before you can stretch it again. That's just the way markets work. The question is, of course, now, kind of what happens through the end of the year. And for that, let's go to Michael Leibowitz. Mike, so what do you were kind of thinking we might have had a hawkish statement yesterday. Turned out not to be the case. So what are you thinking now? And he's sort of there. Try that again. We got you, Mike. Go ahead.
Okay. I thought he couldn't get more dovish. I thought the risk was to the hawkish side, right? He would mention interest rates, or he would say that we could go more than 15 or something to that effect. Yep. And like you said, he played it perfectly. he dismissed any mention of rates. There were a couple questions to him about raising rates, and they're not even thinking about it. And he made that very clear. So here's what matters to the markets, right? The markets are jumping. Everyone's fully invested. So the question is, well, who's buying now? And the answer is it's people buying on margin. And it's mom and pop buying on margin, but it's more importantly, big institutions using margin debt. They're borrowing to buy, right? So what drives that? Well, one thing that drives it is the fact that you can borrow money. So when institutions do it, they borrow money in the overnight markets or 1 week markets. So they're borrowing money for a day or a week, very short term periods. Those rates are zero, right? So they're essentially borrowing money for free. They're slightly above zero, but they're essentially borrowing money for free. So when you look at buying something on margin, it's okay, if I think it's going up, I'm going to make money. I don't have to worry about the cost of that money. But when the Fed goes to raise rates, or the market decides the Fed's going to raise rates and they push rates up, that becomes a problem for everyone using leverage.
Right.
And I think the Fed knows that, and that's why they're trying to ease into this whole taper thing, and they're trying to do it in a way to protect the markets as much as they can. And they've said as much, Lance. They've said that we will telegraph everything to the market. We will not shock or scare the market. Again, what are they doing? And I think they're telling you what they're doing and why they're doing it, right? They're not worried about employment. They don't care about inflation running hot. Their number 1 and 2 jobs are protect the markets and to ensure that everyone can take on as much debt as they ever need, right?
Yeah.
But he's telling you that. He's telegraphing that message if you just read between the words.
Right. Well, and again, for investors right now, and it's interesting, what's been driving the market lately? It's, been a massive short squeeze. We've seen this in stocks like Avis Car Rental, Hertz, Bed Bath & Beyond yesterday. And these stocks that are heavily short are getting run up by a lot of retail traders, and they figured out the game right now. So these retail traders have figured out that if they can start to pile into one stock that has maybe a little bit lower float, doesn't have a lot of trading volume, and they can start pushing that price up, then that triggers these algorithms on Wall Street to start to cover their short positions, and they can create these big spikes in the market. Well, that tends to lift the markets, and we're seeing a lot of that really speculative activity in the markets occurring and fundamentally very weak companies. But this kind of goes along with this whole, kind of attitude we've created over the last really 18, 20 months since the pandemic shutdown, where, again, the Fed's going to bail me out no matter what. So why not just take on all the risk I can take, be the most speculative, take a look at put-call ratios at this point, options. Some of the most speculative activity in the market comes in the options market. The put-call ratio is back down to a record low, which suggests that people are not worried about a correction at this point at all. They're taking on as much risk as possible. This always works out badly, but we keep doing it because we believe the Fed won't allow the markets to correct. A 5% correction may be tolerable, but the Fed will not allow a 10% correction, much less a 20% correction anymore in the markets. And there's some reason to kind of follow into that logic, because every time the market does correct, we start getting comments from the Fed about being more accommodative, or they're taking action and increasing balance sheet expansion, whatever it is. The Fed's become very active in supporting markets.
Right. So, I think one thing we have to think about as investors is, well, what could upset that apple cart, right? What could cause the Federal Reserve to be more hawkish? By more hawkish, I mean that they would taper at a quicker pace, that they'll start talking about interest rates. And while Powell said his words yesterday, and there's no arguing, he was pretty dovish. The Fed, there's 14, 15 other Fed presidents, members that are going to hit the speaking circuit starting as early as today, I guess, maybe tomorrow. They've been blacked out for a week and a half. So we're going to hear some comments from them that are very different than what Powell told us. And the question is, does the market care? Is Powell the only voice that matters? And, we'll find out. But the market is pretty stretched here. And it's almost looking for an excuse to normalize. And not normalize, I don't mean drop 50% to where valuations are normal, but I do mean to just get back to some basic moving averages and get back to it's already trend that's ramping higher. Like Lance said, the rubber band is stretched and it's got to unstretch at some point. So what causes it to do that? I think Fed speakers saying things differently than what Powell said is certainly one. We're going to get another round of inflation data. I don't know if it's next week or the week after, but what if CPI is running even hotter, right? The market's going to start getting concerned that the Fed doesn't care about inflation and inflation is going to run rampant. And inflation is not good for companies. And it's not good for the Fed trying to stay as dovish as possible. So there are some risks on the horizon, but we also have to acknowledge that the market understands that the Fed is pumping up the market, whether directly or indirectly, and that Powell told us yesterday this will continue. They're not going to take their foot off the pedal in any meaningful way.
Well, and again, this is this is going to be part and parcel of what investors are going to have to kind of deal with. We're moving into the seasonally strong. We actually are in the seasonally strong period of the year for markets. Markets are very overbought here on a short term. We do have some things coming up. Over the next couple of weeks, we got mutual fund distributions for the end of the year. That's going to potentially put a little bit of pressure on markets just as they distribute to issue out capital gains, dividends, and interest. But, that would set the markets up for a year-end rally. Certainly doesn't seem to be anything at this point of major concern for investors to become overly cautious. But, as we've been talking about here over the last few days, a little bit of risk management is certainly prudent, taking some profits out of some stocks that have had, huge runs here. But looking for opportunities to, add back to those positions if we do get a bit of a pullback. And we will. I mean, markets do, even if you look back over the last, year, going back to 2020, March of 2020, the markets had, have had regular little corrections back to the 50-day moving average. It's been over 500 days now since we've had a correction to the 200-day moving average, which is now the fifth longest run on record. So, again, there's certainly some concerns here that, some event, some exogenous event that we're not paying attention to could certainly cause the markets to, pull back here in the short term and provide a correction that, is not that big, 5, 8, 9, 10, 11, 12%. Not big enough to really spook the Fed to any great degree. But for investors that have taken on a lot of risk, it could be a lot more painful considering we haven't had a big correction in quite some time.
Right. And just like we talk about the short squeezes, we can have the opposite problem where everyone is levered to the hill in a certain stock or the index itself, and they're forced to sell because of margin. Right. So, those short squeezes work both ways. And, again, there's a lot going on with the Fed. There's a lot going on with mutual fund distributions, politics. So, there's going to be some volatility. Again, it doesn't mean we're going to drop like a rock even to the 200-day moving average, but it does mean there's going to be volatility. So, buckle up. It's okay to stay on the ride. The ride is, it's still a good ride. Jerome Powell told us it is, but buckle up. And if, you have trouble with 3 to 5% declines, it may pay to take some profits and just have a slightly less position in stocks.
And of course, that's the philosophy we all have, as I was saying earlier on the show. Be sure to go by our website, realinvestmentadvice.com. And in the search bar at the top, just type in trading rules. And we've got lots of articles about trading rules, risk management, rules to follow, guidelines to manage your portfolio better. That's all on the website. It's a great source of free information for you to help you manage risk in your portfolio better. New articles are out from Michael Leibowitz talking about inflation, interest rates, what this all means, and how the markets adjust for interest rates over time. It's all on the website now, realinvestmentadvice.com. That's realinvestmentadvice.com. And make sure and register for the upcoming Candid Coffee on November the 13th with me, Danny, and Richard talking about markets, your money, and more. realinvestmentadvice.com.
It's a rich man's world.